Good morning, everybody, and thanks for joining us. My name is Franziska Arnold-Dwyer. Welcome to today's webinar, Insurance Issues Arising from the COVID-19 Outbreak. Today's topic has been driven, of course, by the COVID-19 pandemic, but the underlying occasion is actually one of celebration. Our Center for Commercial Studies is celebrating its 40th anniversary, and in a moment I'll be handing over to the director of the CCLS, Professor Ian Walden, to welcome you all.
Hello, my name's Ian Walden. I'm director of the Center for Commercial Law Studies. I'd like to welcome you all to this webinar organised by the Insurance, Shipping and Aviation Law Institute at CCLS. The webinar, as Franziska said, is part of our celebrations for the 40th anniversary of the Centre, which was launched by Professor Sir Roy Good on the 20th of June 1980. So tomorrow is our 40th birthday. So happy birthday to us. We were obviously hoping to invite you to an event at Lincoln's Inn Fields, but that was before COVID-19. So I hope this webinar is an adequate replacement. Just to highlight the fact that the Centre was designed to bring together academics and practitioners to exchange ideas, and in doing so to foster academic excellence and to tackle the emerging problems in the legal and regulatory framework. So today's topics and the participants yourselves are another example of that vision in action. So I really hope that you enjoy the event and we look forward to continuing our relationship and helping the Centre grow over the next 40 years. Have a good webinar. Thank you.
Thank you very much, Ian. Now we've heard from Professor Walden, and now we'll start our panel discussion. It'll be followed by some concluding remarks from Dr. Miriam Goldby, the director of the institute, of our institute, the Insurance, Shipping and Aviation Law Institute, and then there'll be some time for questions and answers. So our expert panel today, please let me introduce you to our panel members. We have Mr. Jonathan Moss. Jonathan, can you give us a wave? He's a partner and the global head of transport sector and the head of marine and trade at DWF. Then we have Mrs. Sophie Fennell. Can you give us a wave? Thank you. Who is a compliance officer at AXA XL. And then we've got Salome Santos, vice president at Marsh. She is in the aircraft finance and insurance consortium. Is in the credit specialties division of Marsh. And then we've got Dr. Antigoni Lykotrafiti. Antigoni, thank you. Who is a lecturer in transport, energy and the law at the CCLS. And myself, I'm a lecturer in insurance law and the deputy director of the Insurance, Shipping and Aviation Law Institute. So, so to ask questions, the best time to do that would be in our Q&A sessions at the end. If you have any burning questions you'd like to sort of launch on us, you can use the chat box. And the best way is just to address it to myself. But of course, if it's a point of interest to everyone, you can also send it to everyone. And then at the end, we can also take live questions. And you can do that by using the raise your hand button, and then we can unmute you and you can speak to us. Right, so let's turn to our first topic. Who was impacted and which policies might respond? Well, the answer is that virtually everyone has been impacted by COVID-19, and my heart goes out to those who had sickness and death in their families. But leaving aside the devastating impact of the pandemic on people's lives, the pandemic had also significant financial consequences on consumers and businesses alike. And governments around the world have sought to mitigate these financial impacts with benefits and subsidies. But consumers and businesses have also turned to their insurance policies. Now, for consumers, the most likely financial losses are loss of income due to loss of employment in relation to the pandemic or due to sickness. And there are different types of income protection policies. But whether they are engaged depends on the terms of the cover, of course. then most people in the UK who contracted the virus would have been treated by the NHS, but there might be medical expenses for certain treatments and that have been obtained on a private basis. And those expenses may or may not be covered by private health insurance. And then the third sort of major group of consumer policies that may be engaged are policies that cover cancellations, such as travel insurance or wedding cancellation insurance. And again, coverage will depend on the terms and conditions of the policy. Then on the business side, the main type of policies, and that's the one we've heard a lot about in the news recently, is business interruption cover. But there will also be other losses to do with the non-performance and non-payment of obligations by counterparties. And there are different types of policies that might respond to that. Then businesses may also seek to call in liability insurance policies if they're held liable for COVID-19 infections, either by employees or members of the public. And finally, businesses too can suffer financial loss due to event cancellations, either as a participant or if they're the event promoter. And there can also be business travel insurance. So if I could first turn to Sophie, could you in very general terms tell us about business interruption insurance cover, please?
Yes, of course. Hi everyone, thanks for joining us this morning. So business interruption insurance is primarily, in its kind of basic sense, something that is bought usually in addition to standard property cover. So by definition, it's normally something that would have to be triggered once physical damage has been suffered by the insured. So the most apparent example would be, for example, a factory where a piece of equipment has been damaged. So the physical damage insurance will cover the actual loss of the cost for the machinery to replace the machinery and repairs, whereas business interruption insurance, the aim of it is to cover those expenses incurred through loss of revenue, through loss of production for however many days it takes to replace the part. In that sense, obviously COVID-19 has not caused any physical damage to factories, although the factory may have had to have shut, causing loss of income. So some basic business interruption policies, they're not intended to cover this kind of situation. However, there are some additional clawbacks that you can have, additional coverage that you could purchase, where you would have a factory shut, for example, if there was a notifiable disease, which COVID-19 now is, although obviously previously it wasn't because it's new. Also, you could have a certain list of named diseases. So if factory was to suffer loss through a named disease that would be predetermined in contract wording, that could potentially have triggered. But again, because coronavirus is new, it wouldn't have been necessarily named. Then we've also got non-damage denial of access. So an extension of standard BI cover would be where they can't, for whatever reason, access the equipment that they would need to. So that's potentially a way that COVID-19 could, there could be a triggerable loss there. And then also loss of attraction. So that's another extension that could be added on to a usual standard wording. So that's a kind of general summary of how we're looking at that. Obviously, at the moment, we're kind of discussing how those wordings would trigger. So there's special clauses, exceptions that might not necessarily enable a successful claim in BI cover.
Thank you, Sophie. And Jonathan, what kind of policies have you seen engaged also trying to get response to in the marine insurance, or the marine sector rather?
Thank you, Franziska. Good morning, good afternoon, or good evening, wherever you are today, and welcome. And it's a pleasure to be part of this webinar. On the marine insurance side, perhaps we should talk initially about the impact that COVID-19 has had. So what we have seen are closures of ports. We've seen a reduction in demand. So in commodities, for example, not so many commodities shipments are taking effect now. because of the closure of the ports, and we've seen sickness and quarantining of crew members, stevedores, etc. On the subject of which policies might respond, it may be not quite as a rosy picture as Sophie was painting for marine insurance. The principal contracts of insurance are hull and machinery, cargo, and also policies that are arranged by P&I clubs. So starting with hull and machinery, that is for damage to the hull of the vessel and for physical repairs that are needed to the vessel. So it's difficult to see how COVID might impact on that. Two possible ways. There's floating storage. So very old ships are used to store oil as the oil price has plummeted. And it may be that they're not fit for purpose and there are explosions and fires as a result somewhere along the line of the COVID pandemic. Also, ports are seeing many more ships moored there, and it's possible that there might be collisions as a result of the amount of vessels that are there. On cargo cover is designed specifically for the transportation of goods. So if there's a destruction of the cargo, then the policies will respond. So again, it's difficult to tell how COVID-19 might have an impact on those cargo policies. P&I club policies, different, because they are policies that are derived for ship owners and charterers, in the case of charterers, legal liability for risks that are associated with the vessel. So that's where we're going to see the injury claims, the sickness claims, repatriation, quarantining, the costs of rerouting the vessels, perhaps because the ports have been closed or the ports are not safe. So hopefully that just gives you an overall view of, first of all, what COVID is doing in the commodities and shipping world, also what the policies are that are responding. And finally, the people or the entities that are affected include international traders, commodities traders, ship owners and charterers.
Thank you very much, Jonathan. Now, the aviation sector has been particularly badly affected, and airlines have not just looked to their insurances, but also to state aid. Now, can I ask Antigoni to tell us about the impact of COVID-19 on the aviation sector, please?
Yes, thank you, Franziska. So I would also like to welcome our audience, our former students, our alumni, our current students, our prospective students. So welcome on board. So aviation has been indeed affected very much. It is an international industry par excellence. So it is exposed to external shocks. In the past, we had SARS, which was an epidemic. Now we had COVID. We had 9/11, terrorist attack in the Twin Towers. We had oil shocks, wars, the war in Iraq. All these external shocks affect aviation, affect its profitability, mess up with air traffic demand. Now we have seen the global fleet grounded for a prolonged period of time. And aviation is suffering as a result. And the very first reaction of the European Union, for example, if you look back what happened in March, the European Union said it was all about firefighting at the time. So the European Union said, oh, airlines, I know that you are not utilizing your slots at airports. You know that slots at airports, airlines do not own slots, but they keep them on the basis of the use it or lose it principle. So they have grandfathering rights. So the European Union said, airlines, I know that you cannot utilize your slots. Don't worry, you will keep them, even though you can keep them next year, even though you are not utilizing them. That was the very first reaction of the European Union, so firefighting really. But as the crisis worsened, then more drastic measures were adopted in order to address the problem, in particular subsidies, which in Europe we call state aid. You know that the European Union is the only trading bloc in the world that has a fully fledged state aid regime. You know also that national governments cannot subsidize any enterprise without first notifying the European Commission and without getting the green light from the European Commission. If national governments in EU member states grant aid without notifying the Commission and without waiting for the Commission's approval, if the Commission finds out, and the Commission will find out because competitors will complain, then the Commission will order recovery with interest, compound interest. So the beneficiary will have to give back the money to the government with interest. And this is a very expensive business for the beneficiaries. They can go bankrupt. So there is an issue there because in the absence of a global state aid law, a global anti-subsidies law, we have jurisdictions which have a fully fledged state aid regime and state aid control in place, like Europe, and other jurisdictions where we don't know what is the legal framework and we don't know under what conditions airline or in fact any sector of the economy is being subsidized. So there is danger that competition will be distorted and the playing field will be unleveled as a result. If we look back, when in the States we had 9/11 back in 2001, the USS base remained closed for 4 days. And if you see what the US did at the time, the US said, yes, American Airlines, I know that you are suffering operating losses. I'm going to subsidize you for the losses that you encounter during that time and beyond. And because you need war risk insurance, and I know that you cannot get it now on terms agreed before 9/11, I will pass legislation so that you can get your war risk insurance on the same terms. In Europe, the approach was completely different. The European Commission said to the EU airlines, national governments, you can only subsidize your industry for the losses encountered during these 4 days when the USS base remained closed. So there was an asymmetry in the US and the EU approach, and this triggered the European Commission to adopt a regulation in order to address unfair subsidies and unfair pricing practices by third country airlines. And I wasn't at all surprised when 2 days ago I saw on the website of DigiCom a white paper on foreign subsidies and the effect these foreign subsidies have in the EU single market. So I think it is important to ensure, and competition authorities have to remain vigilant and ensure that competition is not going to be distorted when air traffic demand will recover. Franziska, shall I give the floor back to you and I continue later?
Yes, thank you very much, Antigoni, for these very interesting insights. And on the topic of aviation, could I ask Salome, being in the aircraft finance insurance team at Marsh, what are your observations?
Yeah, of course. Thank you very much, Franziska. And, first and foremost, thank you very much for organizing this together with Miriam and for inviting me. It's a pleasure to be here with you all. Welcome to the panelists and everyone who has joined. So following from Dr. Antigoni's presentation and, hopefully for everyone's benefit, I really wanted to give you kind of a specific and actually quite niche insurance example that has been impacted by COVID-19 and which is obviously connected with the aviation sector, that is of the aircraft finance insurance. So I work in a small team at Marsh, the AFIC, the Aircraft Finance Insurance Consortium, AFIC. So this is essentially, and in very broad terms, a product developed by Marsh in cooperation with Boeing to support Boeing customers in accessing finance for the purchase of new aircrafts. So a segment of Boeing customers, either because they're not as good credits as, let's say, a Ryanair or an American Airlines, where lenders would probably queue to finance them, or because they're located in difficult jurisdictions, they would not be able to access financing from lenders without some kind of guarantee or support. So they're heavily dependent on the role of export credit agencies to access financing for their purchases. And because Boeing is a US manufacturer, in this case specifically, they relied substantially on Exim Bank. in the US. So what happened was about 5 years ago, Exim Bank stopped working. So no longer had the quorum to operate in order to support the financing or to provide loan guarantees for projects that were over 10 million without any kind of, there was no knowledge on when the bank would be up and running again. So that's, the underlying reason why Boeing turned to Marsh to develop an alternative financing solution utilizing private insurance that, would work similar to an export credit agency type of financing, but using highly rated commercial insurance companies. So, very simply how the product works is via an aircraft non-payment insurance policy, which is underwritten by a panel of global insurance companies. So the policy essentially provides full protection to banks from the payment default by the airlines or the leasing companies on their loans to purchase the aircraft. So, however, unlike with traditional non-payment insurance, there's an effective risk transfer to the insurers. So the insurers take 100% of the risk. That is the credit risk of the airline, the asset risk, during the tenor of the transaction, of the loan, the jurisdictional risk as well, which is important for repossession purposes in case of default. So effectively, there's no risk retention by the lenders except for taking the credit risk of these highly rated insurance companies. In order to accomplish this and make sure that, insurers are willing to participate and take the risk, the deals, the transaction deals, the underlying deals are pretty much insurer-led. So the insurers select the transaction they want to participate in and evaluate the risk in first instance. There's a separate team set up at Marsh who are aircraft finance experts that provide the expertise that they would need to kind of understand the complexity of these transactions. There's also a panel of law firms that represent the insurers that drive the documentation on their behalf. We work more on the insurance side, the traditional broking side. So again, this is very different from how traditional non-payment insurers, where the lender drives the transaction and then transfers the risk to the market. So obviously, as you can imagine, this unprecedented COVID-19 crisis, which has hugely affected the aviation sector, as Antigoni, described, is also having a significant impact on the aircraft finance market. So just for a bit of context, before the crisis, this was a booming market. So it was a stable growth. There was a lot of funding diversification. The value of air travel is really at the heart of this. Passenger traffic was for 9 years just recording above trend growth. On the other hand, airlines and lessors had some of the lowest historical costs of funding. This all combined with, attractive returns and the fact that this is generally a secured type of transaction by high value assets. This has also encouraged banks to deploy capital into the aviation sector. So overall, a very competitive market. So COVID-19 came really in a very short time frame, changed this whole paradigm. So, everything is quite recent still, and there's a lot of uncertainty how the impact has been felt, and as the crisis developed, the data may change substantially. But one thing that is for certain is it's that since the beginning of the pandemic, COVID-19 has devastated air travel demand. So the numbers show that, the first week of June, 65 scheduled flights went down by 65% as compared to the same week last year. And, at some point, 68% of the global commercial passenger fleet was inactive due to the impact. So, airlines had immediately to deal with the effects of the crisis and, huge liquidity problems. So airlines couldn't fly their planes, they had no revenues coming. And so, they started immediately fleet rationalization, looking to reduce or cancel or defer purchase orders. So obviously this affects on the manufacturer side where there are production cuts. So as airlines revenues come to a decline, there's also the real concern that they won't be able to pay their current debt and obligations and consequently trigger defaults. So, you know, they started seeking also commercial concessions with banks, you know, in the form of rent or loan deferrals or really restructuring the transactions. In tandem with this, the market valuation of the assets is also fluctuating quite substantially, which only contributes to the uncertainty. So all of this naturally, from an insurance perspective, so the crisis really has affected. So although, you know, the situation is still quite fluid, what we see is that there's a lot of focus on the liquidity of airlines and leasing companies. So if there was scrutiny before, now the scrutiny is even higher. There's a huge amount of reporting from insurers and banks to their management, to senior management, to their credit committees. Insurers are being much more selective on the deals that they're taking part of, you know, as they take the risk of the credit airlines. And here, they also tend to focus a lot on the importance of government support and state aid to the airlines, because obviously there's a direct correlation on the creditworthiness and the rating of the airlines. So this plays a huge part in making insurers comfortable in participating in these transactions. But, you know, on the other hand, there's also, you know, real opportunity for products like AFIC and, you know, and similar in supporting the recovery of the aviation industry. Also from, you know, there's also commercial opportunity for insurers to, you know, in this case, deploy their capital for these type of transactions, or, you know, diversify, in the AFIC case, their portfolio and get some better credit airlines that currently wouldn't be able to access financing as easily as before without this type of product supporting them. So I guess this is kind of an overall view. Thank you.
Thank you very much, Salome, for these very interesting insights. And needless to say that many of the issues that Salome mentioned in relation to aircraft finance also apply in relation to standard non-payment credit insurance, which operate on the basis that the debtor will be able to recover under the insurance if the obligor fails to pay, but there has to be a failure to pay, so a default. And of course, if you have restructurings or even if you rely on a force majeure clause, that muddies the water a little bit. But let's move on to our next topic, which is really to drill down a little bit more into wording and coverage issues. We've already said on several occasions that a lot will depend on the actual terms of a policy in question. So prima facie, the title or the name of the policy might look like a perfect fit for the loss suffered, but then the terms of the policy will define or circumscribe what losses are covered and what risks are excluded. So therefore, the starting point for examining whether there's a claim is to look at the policy wording. So you would first look at the insuring clause, what types of loss are insured. You would look at the triggers. So you determine from the policy wording what the triggers or insured risks are. Then you need to look at the policy exclusions. So they are specific risks that are sort of taking away from the cover. Then many policy wordings will have a definition section. So if your insuring clause, your exclusions contain defined terms, this may indeed affect the scope of your cover. And Sophie has already mentioned that this is one of the issues with certain types of business interruption insurance that give cover where the business has been hindered or interrupted on the grounds of notifiable diseases. In many policy wordings, notifiable diseases is a defined term, and it actually gives a specific list of specific diseases, which may or may not include sort of coronavirus or SARS-related diseases. Then you also need to check your claims limits and deductibles. And then one very important aspect to also consider is what kind of causation test your policy employs. So this is how the link between the trigger and the loss is established. Now, the fallback position in insurance law is that the insurer is liable for any losses that are approximately caused by a peril insured against. That's Section 55 of the Marine Insurance Act. Proximate cause means it's a dominant or effective cause, but it doesn't have to be the sole cause. However, policy wordings often use different causation tests that could be looser. So, for example, losses directly or indirectly caused by X. Or they could indeed be tighter and make it more difficult to establish this causational link. And some type of causation test or that has been discussed in the connection with business interruption insurance are these so-called trends clauses, which require the insurer to prove that but for the sort of business interruption, he would have earned, the business would have earned a certain amount, and this can be very difficult to establish. And then finally, you cannot insure known events or inevitable losses. So losses that are already certain to happen at the time the policy is entered into, they will not be covered. So this is of the general background, and then perhaps if I could turn to Jonathan and ask what kind of wording issues you've come across in marine claims to do with COVID-19. Thank you.
Sure. Thank you very much for that introduction, Franziska. Well, what have I seen recently? I've seen a lot of notifications and I've seen a lot of claims that are coming across my desk as I'm a private practice solicitor. And more often than not, I'm seeing the claims notified irrespective of whether the assured strongly considers that they've got cover or not. Because for the reasons I mentioned, certainly with regards to hull and machinery, cargo, and also P&I contracts of insurance, the scope for cover is relatively limited. But that doesn't stop the notifications coming in, because what we're finding is that the assured commodities traders or ship owners or charterers have been impacted by COVID-19, and so they are making those claims. What I think is particularly noticeable at the moment are claims brought about by force majeure. So we referred to that initially. And I've seen very recently, particularly with the insolvencies that are affecting Southeast Asia, so that's the Hin Leung insolvency and the Agritrade insolvency, that there are a stream of force majeure disputes that are on the horizon. And principally, they are because we have oil traders, for example, who have contracted a trade for whatever it is, gas oil, at a certain price, let's say 2 months ago. And now, because of the slump in demand and the prices of oil, they consider that they can get out of those unprofitable contracts and conclude contracts at a much lower value. So they are blaming the pandemic as a means of getting out of these unprofitable contracts. And as we know, force majeure is a concept that needs to be referred to in the contract, whether it's a sale contract or a service contract. Unlike frustration, it is a principle that needs to be referred to and stipulated in the contract. And the difficulties that we're seeing are whether the force majeure pandemic reference is there in the original contract. We normally see riots, war, and epidemic, but not necessarily pandemic. So at the moment, I'm seeing a rise in force majeure disputes, and I'm seeing assureds approaching their insurers, whether they're in the London market or the company's market, and requesting cover. However, when you look at the insuring clause and you look at the exclusion clauses, and you look at the deductibles and the other relevant provisions that you've outlined, Franziska, in your slide, it's difficult to see how those force majeure claims can actually fall within the realms and the ambit of cover.
Okay, thank you very much, Jonathan. And Sophie, you've already given us a very detailed picture of the wording issues to do with business interruption insurance. Are there any others you'd like to add?
Thanks, Franziska. I think the main point to just talk about is that causation point. So that's the real topic that's being deliberated. Whether or not coronavirus is the reason that a factory had to stop producing, or a SME company had to stop trading, or was it actually the government's interjection and the government's procedures that have put the forced closure in place? So then we're looking at whether or not a government restriction could be wording that may be included in a contract, but then we're looking at, well, the government only intervened because of coronavirus, so it's attributing what caused the loss to the specific policy wording. So I think apart from that, I've kind of briefly covered everything else earlier. It's just a nuance I wanted to highlight.
Thank you very much. And of course, all these very tricky issues to do with causation. It's not just a matter of construction, of construing the causation test used in the policy language. It also entails very difficult factual findings. And we'll come back to that when we take a closer look at the FCA test case in a minute. So moving on to the claims process. So once you've looked at your policy and you've ascertained, or you think there might be cover, your next step would be to make a claim under the policy. And for that, you need to check out the claims provisions in your policy wording. These claims provisions will detail within what time limit you've got to give notice, and there are different variations. It could be immediate, which is obviously the most stringent test. It could be within a specified time period, say within 30 days, or it could be as soon as reasonably practicable. And some policies also require the insured to already give notice of circumstances which are likely to give rise to a claim. So it's already at a sort of earlier stage that you might have to get in touch with your insurer. The policy provisions may also specify the form of notice, which is usually in writing, but it can also specify that notice has to be given to a particular party, and sometimes that can be the broker. And the claims provisions may also give details of what's expected in terms of proof of loss. Now, some policy wordings will say that a proof of loss has to be to the satisfaction of the insurer, and then tricky questions can arise. Is that an objective test for the prudent insurer, or is it subjective? Could the insurer ask for anything he likes to make it really difficult? And the more recent cases are suggesting that it's a test that's subject to reasonableness, so the insurer can't sort of delay paying a claim just by asking for more and more information. And this is also reflected in a new or relatively new provision in the Insurance Act, Section 13A, which is a statutory duty on the insurer to pay valid claims within a reasonable period of time. And this can indeed be a very useful weapon in the arsenal of an insured who's waiting and waiting and waiting and doesn't get his claim paid. Now, this claims provision also as a sort of little note of caution, there can be consequences for not complying with these provisions, for example, missing a deadline, which can be particularly serious if the notice provision is a condition precedent to liability. But however, most notice provisions are mere in intermediate terms by way of contractual classification, which means that just by submitting a notice late, you wouldn't immediately forfeit your claim. But again, it depends on the terms and conditions of your policy. Now, just going back to Jonathan, sort of subject to client confidentiality. Have you seen any actual claims being made, and were there any claims process issues you've come across, maybe to do with the time periods?
Yes, it's a very mixed picture. So you'll find the assureds that are very familiar with the terms of their own policies, and also who have a very close association with their brokers, and they will notify of a claim within a reasonably practicable period, or within 21 days or 14 days. And then you have the other assureds who are not quite so savvy and won't reply within those stipulated periods. And it's very much down to the carrier, down to the insurer, to determine how it responds to those sorts of claims. And there's an element of discretion. And you will find that some insurers, some carriers will be committed and dedicated to looking at the terms of the policy very strictly, and then denying cover or throwing out cover because the actual claim doesn't fit within the scope of the policy and the notification hasn't been made in time. Or you'll find that the insurers will take a much wider and much more generous view and consider that down the line they're likely to have to respect cover and will indemnify and will pay. But I think that what we are experiencing, or what we have experienced in the past 3 months, is a certain sea change, because insurers, reinsurers are very aware that many claims are coming through and the market is being flooded. And when that happens, you'll find that the consensus really is to take a far more I suppose, specific approach to policy terms, scrutinising the terms and provisions to determine whether there is cover. And we're also seeing more delays. So insurers are spending more time poring over policy terms before they reach their decision, which can be a cause of frustration for the assureds who want to have some sort of confirmation or approval in a short period of time. But they're not getting it as a result of the pandemic.
Thank you, Jonathan. And then, of course, in relation to consumer policies in particular, there is, of course, also some pressure from the FCA, who is expecting insurers to deal with claims sort of quickly, flexibly, and fairly. Sophie, as a compliance officer, is this something that has sort of impacted your firm's sort of claims processes?
Yes, definitely. I think also, so the London market, those insurers participating in the Lloyd's market are also receiving pressure from Lloyd's as well. Not only just to kind of ensure that the claims process, we're treating customers fairly, which goes to the point of how quickly we're reviewing the claims, but also there's stipulations, for example, from Lloyd's to say, as an insurer, you can't cancel an insurance policy just on the basis of non-payment of premium when those insureds are suffering financial hardships. That goes back to the consumer point. Consumers, but more so SMEs, micro enterprises who can't pay because their income has just stopped, but they need their, for example, buildings insurance cover. Insurers are put pressure on to not able to rely too much on the fine on the print of the contract, which says if you're paying instalments and you miss a payment, then your insurance is invalidated. If that missed payment is because of financial hardship, because of coronavirus, then insurers are being looked at to honour those policies.
Thank you very much. And of course, claims and presenting claims is also traditionally something brokers can help with. So if I could ask Salome, with her broker's hat on, what are your sort of insights on COVID-19 claims?
Yeah, so, a general overview. As an intermediary, the role of the broker in administering claims is it's pretty relevant. So they work as they function as a bridge between the client and the insurance market. So there's a lot of work that goes on into administering the claims, and also a lot that can go wrong. So I see the role of the broker as essential in this process, especially in a situation of crisis like the one we're living in, where clients expect to be paid. So I think the biggest differentiator here is that a broker is invested in making sure the process runs smoothly and claims are paid timely and effectively, and more importantly, that the product works as they should. So that starts really with the placement of the insurance in the first place, making sure that the policy language is clear and robust so it can respond in case of a claim. But, really when a claim comes in, the worst thing that can happen is for the process to go wrong, affecting the credibility in the products and, ultimately the reputation of insurance and the confidence of clients on the industry. So, insurance is in place to support businesses, and I think brokers have a huge role to play in making sure that, the clients have the confidence in the insurance market and continue to use it as a preferred way to manage their risks. I think this is, the information that I think I wanted to emphasize more.
Thank you very much. That's really great. So we've already mentioned it a few times. I just wanted to say a few words about the FCA test case. So on the 9th of June, the FCA started proceedings against 8 insurers under a special procedure called the Financial Markets Test Scheme, which is under the Civil Procedure Rules, your Practice Direction 51M. And really this is designed for cases that raise issues of general importance in the financial markets, in relation to which an immediate court ruling or guidance on English law is being sought or needed. And this case is also proceeding on an expedited basis, so the main hearing will be for 8 days between the 20th and the 30th of July. And because of COVID-19, there's actually it's almost like a Zoom or a Skype link, so you can listen in to the court proceedings, which is very interesting. Now, an important point to note about this FCA test case is that it doesn't deal with those standard business interruption policies that rely on physical property loss. So it only relates to business interruption insurance policies that have that extended cover. So where you have a closure due to government action or to infectious diseases. Now, the FCA has selected representative wordings from different insurers, and the central questions for determination submitted to the court are whether loss arising as a result of this interruption with the insurance business are covered under these policies, and to establish whether there's the necessary causal link between the losses and the relevant period covered. Now, when the court is going to give a ruling after the hearing, this decision will be legally binding on those insurers who are party to this case, which I've listed on the slide. But of course, it will also provide highly persuasive guidance for similar claims and the similar wordings. And in connection with this test case, the FCA has also given guidance on its expectations on insurers and insurance intermediaries when they deal with such claims and how complaints are to be processed. So with that in mind, brings us on to our next topic, which is regulatory issues. So in addition to the FCA test case and the guidance on business interruption insurance claims, there are also a variety of other regulatory issues that have surfaced. And the FCA has communicated its expectations on insurers for other types of policies as well. So there's been a Dear CEO letter back in April. And there's a whole raft of FCA guidance notes on their website. But the key messages really from these guidance notes is that the FCA is expecting insurers to be flexible and treat customers fairly. So as Sophie has already mentioned, if somebody falls behind with premium payments or thinking about sort of people working at home instead at their offices, and there being changes to their commute pattern, to their work pattern, but also perhaps not being in their usual residence for an extended period of time. So the FCA has said they don't want this kind of changed conduct to impact cover under policies. And then, of course, as Jonathan has mentioned, we are seeing a real large numbers of claims coming in. There are multiple claims from multiple insurers in multiple lines of business in connection with the COVID-19 outbreak. And in that sense, the pandemic is not just a human catastrophe, but it's also an insurance catastrophe because of this accumulation of losses. And in that sense, it's also a sort of a warning flag has to be raised for firms operating under the Solvency II regime. So they really must assess whether the insurance products and the risk exposure, what it is in relation to COVID-19, perhaps have a wordings review to assess whether there's affirmative cover, meaning expressly covered, or silent pandemic risk exposure. And this will be a similar process that firms have gone through in relation to cyber risk. And then, of course, with lots of claims coming in, firms have also need to consider the effect on their balance sheets and what it means for their capital resources. So moving sort of in connection with this of catastrophic scope or potential catastrophic scope and accumulation of losses in relation to COVID-19. This also brings me on to reinsurance, because many insurers will turn to their reinsurers to see whether they can be indemnified for the claims they have paid. Now, as a reinsurance lawyer, one aspect of the FCA statement that really concerns me is their expectation that insurers should deal with their claims flexibly. Because what the FCA is really saying, but without saying it very clearly, is that insurers should pay claims which, on a strict reading of the policy wording, are perhaps not covered. Now, the reinsurance case law is absolutely clear that, subject to any provisions to the contrary in the policy wording, a reinsured, so the insurer as a reinsured, has to prove first that the loss is covered under the terms of the underlying policy, so the original policy, and second, that the loss is also covered by the terms of the reinsurance policy. So a reinsured who's followed the FCA's expectations and has paid claims that he was not legally obliged to pay has a reinsurance problem on its hands. It will not be able to prove the first point. And the reinsurer can then raise coverage issues and defenses in respect to the underlying policy. Now, a practical way of dealing with this is, of course, for insurers to get in touch with their reinsurers. And I'm sure lots of these conversations are already taking place in the market. And for insurers and reinsurers to agree in advance how these claims should be treated. And then the situation gets even more complicated if we have follow the settlements wordings and how this impacts on claims. Now, with reinsurance claims, there are also going to be very interesting issues, I can imagine, in relation to aggregation. Many reinsurance policies will contain an aggregation clause, and this kind of clause seeks to treat two or more losses that are linked by some unifying factors as a single claim. And how losses are aggregated has a direct impact on the measure of indemnity. And it can benefit the reinsured or it can benefit the reinsurer. For example, the combination of two losses under the aggregation clause may work in the reinsured's favor if it means that the claim breaks through the deductible. But on the other hand, the aggregation of losses can operate to the advantage of the reinsurer if there's a limit of liability for each claim. And there's a lot of case law to do with event-based aggregation, occurrence-based aggregation, and cause-based aggregation. And this will all be very relevant once claims sort of trickle through into the reinsurance layer. And then finally, because of the potentially catastrophic nature of COVID-19 insurance and reinsurance coverage, the insurance industry has also started to think about backstop and mutual arrangements to find an industry solution for future pandemics. So in the UK, the UK insurance industry has formed a steering committee, and they'll work with the government-backed reinsurance fund, Poolre, to develop some kind of approach to pandemic cover going forward. And we see similar developments in other countries. For example, in Germany, the German insurance industry has come together to develop a pandemic risk fund to provide risk capital. And this may take the form of a pandemic cat bond. Now, these future developments bring us neatly to our very last topic. So we're going to look into the future, into our crystal ball. And one thing seems very clear. With insurance being so much in the public eye in these times of coronavirus, the way insurers are going to deal with claims and renewals, premium refunds, and wordings now will have a huge impact on the public perception of the insurance industry for years to come. And likewise, the FCA test case will define the relationship between the insurance industry and the regulator for some time to come. So maybe if I turn to Jonathan and ask him to look into his crystal ball for the marine insurance market.
Thank you. Yeah, I've got my crystal ball on my desk here in the middle of London, so I'm looking at it, and I've got my tarot cards as well. I think that from the lawyer's perspective, we're going to see much more litigation. I think we're going to find that there will be disputes against professionals. We know that one very large firm of accountants signed off on the books of a Southeast Asian trading and shipping company that had debts of $4 billion, and that HSBC lost $600 million as a result. And so we're going to see professional negligence disputes. We're going to see disputes instigated by banks. We're going to see restructuring, insolvencies, force majeure disputes, ownership of oil, if the oil's been commingled. In a downturn, in a cyclical downturn like we have at the moment, this will generate litigation, and that will trouble insurers because insurers will be asked to indemnify, to step into the shoes of the assureds for those disputes. So that will get insurers considering their own positions. And that leads, I think, to the next point from my crystal ball. And that is that we will find insurers exiting the market. I speak with reference to my particular area of marine insurance, and some insurers will think that the actual premium income they're getting isn't worth the claims that they're paying out on. So we will see exits from the market from insurers. And at the same time, maybe 6 months, maybe a year's time, you'll also see those innovative insurers that are ready to move back into the market, because they'll see that there is no capacity for the assureds, and the assureds need insurance. So you'll find canny brokers and canny insurers moving back, charging higher premiums for new cover. And you'll also find new products being offered by brokers like Marsh to capture those companies that might be on the rise as the recession subsides, hopefully very quickly. So I hope that gives you an idea of what I can see in the future.
Thank you very much, Jonathan. And Antigoni, what's on the horizon for the aviation sector or the transport sector more generally?
Right. A lot of implications, Franziska. I'm not going to focus on the discomfort of travel nowadays, having to wear face masks, leaving the middle seat of the aircraft empty, and whether the airlines can achieve the economies of densities they need in order to break even, etc., or quarantine measures and health checks on arrival. I will just mention one thing on fares, airfares and their rates. I think in the short term, it is likely that the airfares and their rates will go down because airlines will offer discounts since demand for air traffic is still very weak. In the medium term, I believe that airfares are going to increase until that point when airlines are subsidized. And then I fear that unless competition authorities stay vigilant, it is likely that the airfares will increase. And maybe we will experience the phenomenon of predation. So subsidized airlines with deep pockets, charging initially very low fares, below marginal cost, in order to squeeze the competitors out of the market. And these competitors are going to be small airlines, regional airlines, whose governments do not have deep enough pockets to subsidize them. And once these airlines are out of the market, the legacy airlines, the bigger airlines, are going to increase their prices a lot to charge inflated prices, and this boils down to predation. So competition authorities have to be vigilant. And another point I want to mention is that this COVID-19 pandemonium has opened a discussion, which in fact has always been there in aviation, which concerns the way we have regulated the industry. Because if each time there is a crisis, every 5 years, every 10 years, every 15 years, we have to bail out the entire industry, then perhaps we have to regulate it and run it and insure it as a utility. Perhaps aviation is not just an economic activity like any other economic activity, but it does also have public utility characteristics. And if we all agree that we have one air transportation system and we cannot afford to shut it down absolutely, because unless we subsidize, these airlines will go bankrupt, which we don't want because we need air connectivity, and air connectivity brings vitality to the economy. So if we agree that shutting the whole system down absolutely is an insurable risk, then the question is, who is going to be the insurer? And it seems that the society, so taxpayers as a whole, have shouldered a large part of the risk. So then the big question is, when we come back, is private enterprise going to invest in this business again, or are we going to have to formalize the insurability of the continued operation of the airline industry? And this is not a question really that I am intelligent enough to conceive of myself. I was watching the other day on the web Robert Crandall, who is a legend in the industry. He is one of the most successful CEOs. He has been the CEO of American Airlines for well 2 decades. He's the guy who invented yield management, computer reservation systems, frequent flyer programs, and he exactly put forward these questions. The big question as to whether aviation is just an economic activity or a public utility. So
Thank you very much, and very interesting thoughts on seeing aviation as a public service, a public utility. And we don't have much time left, but I very quickly want to ask Salome, as a broker, what do you see might change? Are there going to be changes to the insurance distribution model, perhaps?
Yes, thank you. So yeah, aside from kind of the general advisory and consultancy role that the brokers play, the broker relationship and leverage with the insurance markets, the technical teams and dedicated expertise really, and as Jonathan really introduced this topic, the role of sophisticated brokers, or the role that they play, is to bring innovation into the insurance market. They're really in a privileged position to understand the business needs, and because they're very close to the clients. So, AFIC, let's take AFIC as an example, which utilizes private insurance to support an industry, in this case, the aviation industry. Without AFIC and similar products, a segment of airlines would not be able to get finance or financing to purchase aircraft. And this goes to, Antigoni's point as to the relevance that airlines play in many jurisdictions. Actually, just as a fun fact, the term backed finance, as referring to the private sector insurance backed support, was born after AFIC was launched, about 3 or 4 years ago. So, there's a huge role here in insurance in the recovery of the industry post-crisis, and the specific example of aviation, answering the questions, how can the aviation industry rebound, and how can some countries continue to maintain their airlines and have modern fleets to the standard that, provide passengers with the confidence in air travel. So I think we'll see a lot more innovation. Thank you.
Thanks very much. And Sophie, very briefly, because we have very little time left.
Thanks. I think we've touched on it from a compliance functions perspective. Just increased regulation, increased focus on product suitability, ensuring that if insureds did think that they were covered for this type of situation, making sure that the product is meeting those requirements of the insured. And like we touched on earlier, there are going to be initiatives which seek to provide some sort of funding going forward, like the PORI initiative, and we're also seeing discussions in the US to support the terrorism initiative there, TRIA, but PRIA for pandemic. So just watch this space for increased reporting and increased supervision, I think.
Thank you very much. And certainly from academia's perspective, the COVID-19 outbreak is going to be a very rich source for our research, and also lots of interesting sessions to teach. Now, on that note, I'll be handing over to Dr. Miriam Goldby, who's the Director of the Insurance, Shipping, Aviation Law Institute at the CCLS. Before we go to questions and answers,
Thank you, Franziska. I'm Miriam Goldby. As Franziska said, I'm the Director of CCLS's Insurance, Shipping and Aviation Law Institute. Now, the name is admittedly a bit of a mouthful, but we like to call it by its acronym, ISALI. Franziska has asked me to say a few words about the Institute's work on insurance while she looks through the questions posted and selects a few to address to the speakers. I want to start by thanking our speakers for the fascinating discussion we've just listened to. We are extremely lucky at CCLS not just to have such exceptional alumni. In fact, all but one of our speakers today are CCLS alumni, but also to be able to count on them so consistently to enrich our scholarly endeavours, and they do so with insight from practice. Jonathan has been a good friend of the Institute since it was established. It was established in 2012 as the Insurance Law Institute by Professor Philip Rawlings, who retired last year, but who remains actively involved. Jonathan graduated from CCLS before we had an insurance law LLM program, but we have benefited enormously from the career path he chose. He has given guest lectures to every cohort of insurance law students we've ever had at CCLS, lectures which were as entertaining as they were informative. He has also mentored several of our students. Salome was in our first ever insurance law cohort, and she was the student representative for that cohort. That was academic year 2012 to 2013. She has remained closely engaged with our activities. She has organized internships, and some of our subsequent graduates have also become her colleagues at Marsh. Sophie was also a student representative this time for academic year 2014 to 15. She has continued to support us since her graduation, amongst other things, through participation in networking events and career talks. In short, we have benefited enormously from their contributions, and they are a testament to the high quality of our graduates. Now, each year we are able to secure a good number of high-quality taught masters and PhD research students, as well as visiting researchers from across the world. Now, we integrate all of these people into our institute's activities. Textbook teaching is not what we do, and every single one of our modules is enriched through insight from practice and through our original academic research. As an example of our strong ties with legal practice in this field, Franziska and I edit the British Insurance Law Association Journal and contribute to BILA's activities. ISALI academic members have produced and continue to produce ambitious, influential and socially significant research. We see our research endeavours as an iterative process where we learn from the industry, from its legal advisors and its regulators. And we also disseminate our findings widely so that they in turn have an impact on law and on regulation and hopefully on wider society. You can see our most recent activities and publications on the ISALI website, but I'll take this opportunity to bring to your attention the latest publication by the Institute's Deputy Director, that is Franziska, who moderated today's session. The book is, she didn't want me to do this, but I insisted. The book is based on her PhD thesis research, which I was fortunate enough to supervise together with Professor Rawlings, and addresses a topic which remains controversial, but at the same time of fundamental significance to insurance law. I will conclude now by thanking our speakers again for this fascinating discussion on the impacts of COVID-19. What we have discussed today is only the tip of the iceberg. We have not, for example, had the time to go into prudential regulation matters, but there are, of course, many interesting issues to be examined also in this arena, not least the controversial matching adjustment process. Challenges of a legal nature are also emerging in other jurisdictions, and in this regard, I would like to draw your attention to a BILA lecture that will be taking place on 13th July by a good friend to CCLS, Professor Daniel Schwartz, on the subject of the American legal system's response to pandemic-based claims for business interruption coverage. That's it for me. I'll now hand over to Franziska for questions.
Right, thank you very much. So we've had a few questions, and let me just find them. So we've had a question on PROCUS from Andrea Fejos. It says, on the point that PROCUS will need to be creative in the future, how does robo-advice fits with the picture? So how can we integrate AI and automation into distribution processes? Sorry to hit on you, Salome. Do you want to say something on that?
Yeah, sure. I mean, I really, this is really outside my expertise, and I really don't have an answer, you know, a specific answer to my knowledge. But you know, obviously, as I said, as you know, as a sophisticated broker will have an array of teams and specialties. So not only the role of placing and insurance, but also the consultancy side and the analysis. So, you know, as long as there is a close connection between clients' needs, and that can be, you know, a huge corporation or a group of problems that several clients bring. So as long as there is that need, I'm sure that, you know, teams will be set up like the AFIC team was set up to address issues that come and that are absolutely new. So apologies that I won't be able to discuss to AI and Thank
you. I know Miriam has some insights on that. Miriam, if you're still there. No, she isn't. Sorry.
Sorry. I am here. I'm just struggling to put my video on. Thank you. Yes, well, AI. We could talk all day about AI. We should have a separate seminar just on that. Well, there's not very much I can say, I'm afraid. I do think it's something to be observed very carefully going forward. There are a number, speaking from an academic perspective, there's a number of funding opportunities for research in this field. It's of high interest and is likely to be of very impactful to society if you look at the potential use cases for the use of AI. But of course, in terms of insurance, it raises very hard to answer questions about how we assess the risk, how we price it, and whether anyone can be persuaded to cover it.
Thank you very much. And Jonathan, I'm not picking on you. It's a question from Helen Murphy directly for you. What is the best advice that practitioners can give their clients for when drafting a force majeure clause? Should we be adopting vague or specific wordings?
Thank you. What a good question. I think that what you should be advising your clients is that the force majeure clause should be as extensive as possible. So it's not simply possible to refer to an act of God or force majeure. You need to stipulate each of those potential force majeure events, whether it's tsunami, whether it's earthquake, whether it's pandemic as opposed to epidemic. So my first indicator would be to make an extensive clause, and then also be specific about the reporting that comes as a result of the force majeure event. So who is the force majeure notice to be addressed to? How is it to be demonstrated? Where is it to be sent? And how is the response to the force majeure notice to be drafted and prepared as well? But most importantly, in response to that question, you can't forget about a force majeure event in a contract, because if you do, then no force majeure event will be contemplated by that contract. So I hope that answers the question.
Okay, thank you very much. Do we have any other questions? We are already overrunning, so apologies for that. Can't see anything. If there are any more questions that occur to you later, please do email me, do get in touch with me. And I will either forward your question to the relevant expert or even try to answer it myself. So thank you very, very much for joining us. And thank you to our expert panel, who've been fantastic and have presented us with lots of very interesting insights. Thank you very much.